Let's discuss global markets, global equity markets, commodity markets, and currency markets with Hartmut Eisel, head of CIO Research APAC with UBS. Hartmut, this is Nikunj Dalmia from the Mumbai studio. Good morning and thank you for joining us. Do you think global money managers are slightly disappointed that they have heard virtually nothing from the US Fed last night?
Well, I think some certainly are. As far as our view is concerned, we pretty much expected Bernanke not to get out the big gun and do an outright QE at this point. Some of the macro indicators are turning weaker indeed, and that warranted a response. But we think the QE, so a medium-sized measure, if you will, not the heaviest gun yet, was the right decision, especially after a successful Greek election, so he can keep it in store in case he needs it a bit later in this year.
Okay, let's just walk you through how the market is panning out right now. The Asian market first, and really not really enthused by what the Fed commentary was overnight, because it seems like the little bit of easing that we've seen is something that the equities had already priced in. Asia, yes, Asia is in the red, down about almost 1% pretty much across the board. Shanghai is the one which is taking the sharpest knock right now, down by about 1.5%. Hartmut, if you can hear me clearly, the bigger disappointment I think overnight from the Fed commentary was the lowering of the growth target for the US equities. Do you think that is something that the markets are more disappointed about than cheering about the fact that there has been another round of easing?
I still believe that probably the lack of QE was the main disappointment for at least many in the market. You see, the macroeconomic forecasts, be that unemployment or also be that the macroeconomic growth numbers, they looked quite high from the Fed in the last couple of months anyway. So I think everybody expected them to come down. And as a matter of fact, we at UBS, we're still quite a bit below the current numbers even.
Do you think it's a matter of time, if maybe not a quarter, maybe a couple of weeks, the Fed will be forced to announce a QE3?
Well, watching the trend, we think the likelihood has certainly increased. We think the likelihood is just about 30%, so yes. But on the other hand, I think they also might want to be a bit careful, watch a bit more data. Remember the most recent downtrends in some of the data that the Fed watches to determine whether they will QE or not. That has deteriorated, but only very recently. So you probably need to wait a bit, for that data to be confirmed really before you take out that big gun.
Hartmut, do you think now that we're done with the Fed meet, the focus now is on Europe and the outcome of the EU summit and what may actually come about from there?
Yes, I think we are very much focusing on the EU. Greece, mind you, still bankrupt. We still think they need another haircut, but we're probably postponing that very issue now for a couple of quarters. It might be quiet around Greece. But the next candidates to be in the focus of the markets would argue is Italy and is also Spain. We would not be surprised if we see rates picking up there again, and that might also eventually require the ECB to step in. So yes, we think this is probably where some turbulence is likely to come from in the coming months or weeks even.
Hartmut, if I look at the global money allocation, there is plenty of liquidity, but all the liquidity currently is parked in US Treasuries. When do you think money will start moving out of US Treasuries?
I think a big determining driver will be when the policy side reacts. And this is almost around the world. I think in most regions, certainly in Europe, to some degree also in the US, or even here some countries in Asia, there's a lot of tendency right now by politicians to leave a lot of the heavy lifting up to the central banks. So the central banks are required to pump more money and more liquidity, but there are limits to that, and all these central bank chairmen, they will tell you that. They tell it to their politicians. So I think what the market really wants to see to get really invested is also more action from the policy side. I think when you see that, then the market will assume, yes, your investment outlook, your profit outlook is improving. Only then I think will people really return to the markets.
Hartmut, two triggers really? No QE3, which should be fundamentally positive for emerging markets like India, and the crude cool-off that we've seen. Are these two factors enough for you to become slightly bullish on India in the near term?
We're fairly neutral on India at this point. On maybe the negative side of it, we see the well-reported stalemate on the policy side. We also see high inflation limits, RBI's room to act here. And Sensex around 17,000 is not necessarily at bargain levels. So we wouldn't jump into the broader market. However, what we also note is that what I call good governance companies, so companies you will not see in the headlines for any scandals, etc., companies that have sustainable levels of debt, those have traditionally traded at quite large premiums, and maybe together with the market to some degree, many of those have also come down in terms of valuation. So we think rather than firing a broadside at the market, what you do want to do, you want to be selective and you want to pick up these good corporate companies for cheap for now.
Give us an example of what is there on your radar when you say you like companies which have good corporate governance.
Yeah, we focus here on several different sectors. One sector we focus on, for example, is power. We think that if there's any major change on the policy side, the low-hanging fruit really is the power side, and we have seen several states already last year hiking the price for electricity, which is a good thing, is a reform measure. We expect more, especially Uttar Pradesh. I think we're waiting for that. So here in these names, you can see a couple of opportunities, also maybe on the power financing side. Along with it, we're also seeing, finally, after almost 2 years, a couple of bigger approvals, or at least pre-approvals on the mining side. So we also would think that in the mining area, to some degree, maybe even construction, those are the beaten down names from last year, and those are probably the ones when you just have a slight policy step in the right side that could do quite well.
Hartmut, besides power that you just talked about, what are the other names that you have on your buy list right now?
We do, as I mentioned, have some mining exposure or also metals exposure. Those names have suffered a lot last year, that many of them trading far below book value, which typically when you have at least a stabilization in the economy, they should be the ones to rally again. And people, in my view, would then also switch from the winners of last year or also the last couple of months to some degree, the stable consumer stocks, a bit more into these more cyclical names. We think that is imminent to some degree. It has already happened even. We expect that to continue for the rest of the year.
Hartmut, when you say that you have exposure to Indian mining stocks, well, the only one I can think of is Sasagoa.
Yeah, well, I mean, the general complex mining and including also the metal companies with it. And mining, the way you can play it, you really is, for example, when you see in easing in the policies in mining, you could, for example, think of some of the metal makers or even the power companies that benefit from that. They're not actually miners as such, but they have captive blocks, for example, waiting for approval. So when these get approved, these stocks typically react quite positively.
As a minority shareholder, are you in for the favor of Sasagoa and Sterlite?
We're not usually discussing the single companies here so explicitly. What we usually do is we drive a sector approach. We recommend a diversified one, and the sectors that I mentioned, you see actually that there is a lot of correlation in that sector. So once you have these policy measures, and we're seeing the first steps, typically you'll see the sector moving a little bit in lockstep anyway. So we rather advocate that kind of more diversified approach.
Now, for last calendar year, Indian equities in absolute terms, they were down by about 7%. In dollar terms, they were down by about 14-15%. Do you think FY13, which is the current calendar year, that could be a good year for Indian equities?
I think it could be a good year, although much of it has happened. Going into the calendar year, we actually were probably one of the few on the streets who had an outright most preferred or overweight, if you will, on Indian stocks. Into the rally, when India became pretty much the best performing market in Asia, we took that to a neutral. struggle a bit to see that you'll see another round of very enthusiastic buying into the market without policy measures, and we do not see bigger ones on the radar screen at this point. So I think for the rest of the year, probably have made some of the performance that was in the cards. For the rest of the year, I think more or less in line with the rest of the Asian markets.